Donald Trump is proposing excluding institutional investors from buying single-family houses. I don't know if he's trying to codify this in law, I guess, in Congress, but if you check out Truth Social, he just dropped this. So what does this mean for us? What does this mean for maybe home buyers, individual home buyers? What does this mean for real estate investors? What do you think, Gabe?
Yeah, I'm not sure how I feel about it. I mean, I think Donald Trump says a lot of things to get a lot of attention. I think I think that the majority of American people, the majority of the population, believes that corporations shouldn't own specifically single family real estate, that it drives up prices. It's not something I've thought a lot about. I do think, there's periods of time in certain areas where large companies, BlackRock and such, have purchased up neighborhoods, have purchased a lot of single family homes.
Yeah, I mean, we know some guys that have made hundreds of millions of dollars in the run up doing that.
For sure. But I think, I don't have it in front of me, but I think it's a very, very small percentage of single family homes are owned by these large companies. So, I think that, does it have an impact on housing prices? Absolutely. But I think it's very, location specific. If you live in a town where BlackRock comes in and they're buying, 50% of the single family homes, yeah, it's gonna have an impact. I need to look this up, so I shouldn't probably speak, out of turn here. But I saw something that was like 0.6, a sixth of a percent, so less than 1%, almost a 0.5% of single family homes are owned by these large companies.
Why? I mean, is this a fear tactic that's a very low percentage. Is this a fear tactic to get people?
And again, don't quote me on that. Don't quote me on
I'm quoting you, man. Here, the real Gabriel Handel just announced. Oh no, I get it. And it's low. It's low though.
It's less than 1%. It's a low number.
Okay. Less than 2%, let's say, double that. Like, is that so why is this because I know, is this just politics? I'm going to get into how I feel about it in a second, because I'm still formulating those thoughts, but is this just politics? Is this just fear mongering to garner votes? Is this saying, okay, we're sticking up for the little guy, the single family home buyer? It's easy to villainize these large institutional players. It's also you got a politician, Donald Trump, or anybody for that matter. Home ownership is a pain point in this country, right? And so this is a really easy way to villainize the big bad capitalists, right? And then make the individual home buyer who has a vote feel better. But really, does it even make much of an impact?
I don't think on a global scale, or I guess on a national scale, it probably makes a huge impact. I don't think BlackRock and some of these large companies are as disruptive to communities as people may think they are. Again, we're talking a low percentage of these homes. I do think on a micro location or specific areas, yes, it can have a big impact. And yeah, I think a lot of it is politically derived, right? Trump has talked about a 40-year mortgage, or was it a 50-year mortgage? I forget. Yeah, 50-year. Trump's talked about a 50-year mortgage, and I think there's a lot of political reasons for Trump to say, hey, let's make homes affordable. Here's a way to do it. Just like you villainize, these large corporations that are buying up these single family homes. And maybe, that'll get some of these younger voters to go, yeah, I like what he's saying. That makes sense. Fuck the corporations. I want to, do I think it'll actually make homes more affordable? Probably not. I don't think it's going to have the impact that it might politically have.
Yeah, I agree with that. I think that if it really is under 1%, then this is a political move. It's really more about the PR that you're getting out of sort of the narrative, but you're not going to move the needle on affordability, I believe. I think the true affordability crisis comes down to supply and demand fundamentals. You had a lot of builders leave the market in 2008. And so we've always kind of been behind. Some markets have been, there's been building and things like that, but and now with inflation, it just doesn't pencil for a lot of these builders. So now you've got a lack of supply and more demand, and that's driving prices up.
But wasn't it also some of these big companies that were buying up that supply after 2008, when the single family home market was stagnant, when there weren't home buyers, people weren't approved for loans, people weren't buying single family homes. Isn't that when some of these companies jumped in and started buying these homes? Was back when there was all this supply and really
Probably.
no
I
demand?
would. If I'm BlackRock, I'm sitting on a boatload of cash. I know the basic economics of this. I know that I'm going to come in. I'm just saying a lot of builders left, so not a lot. So construction lagged, and then material costs have caused that to be more of an issue. But yeah, I do agree. I think even on a smaller scale, some of the people we know that went out and raised capital and bought large swaths of home portfolios, that was in the run up. That was post 2000.
The banks had a bunch of bad loans on their books, and individuals weren't in a position to go sweep those up. They weren't in a position, they weren't going to go buy a property anymore that they couldn't afford, that they weren't approved for, and, be backward. So, I'm not saying that these big corporations were the savior of the real estate market, but these banks had all these bad loans. They had homes that they didn't want on their books. And, I think that is when a lot of these larger companies came in and bought these single family homes. Now you have people upset going, well, this has drived up pricing, and that's not, it's not a direct impact. That's not what's caused real estate to go up and become unaffordable for the average homeowner.
I agree. And you know what causes things to get more expensive? Inflation. And I get so irritated. I tend to lean more right in a lot of what I think, but or maybe libertarian. I don't know. Like I'm a big believer in like just having the government stay out of things, especially when it affects supply and demand. So fundamentally, it like irritates me a little bit. I think just because of the nature of kind of leave, small government, leave us alone. Make sure we're not screwing people and we're healthy and safe. But like let economics take care of economics. And I'll get to that in a second. But the thing that like irritates me about politicians, I think, is when you print money and you inject 25 or more now percent of our money supplies from government printing, devalues the dollar. It's an invisible tax. It fucking hammers the middle class. We know that, right? And the middle and lower class. Inflation is crippling a lot of people. And it's a direct cause of asset growth when we own assets, which is good for us, but it's also the direct cause of housing prices going up along with supply and demand fundamentals. You sort of have like, in my mind, like a double whammy there. And then they always find the big bad villain and blame it on them. I print money. It's like back when the Democrats were blaming grocery stores for raising prices when they were over on the other side printing an obscene amount of money and devaluing the dollar. And here they go again. They're just villainizing. And it's not the left, it's not the right, it's all politicians. They find the villain, they cause the problem, and then they find the villain. And so I tend to believe like stay out of it, let supply and demand fundamentals take care of itself.
But let's solve for that, Travis. So, like, I'm curious. So, I think about, look, we as real estate investors are always in a better position because we own assets. And we talk about that on the podcast. We talk about that in our elite mastermind. Like, those that hold assets are in a better position because real estate specifically outpaces inflation. There's cash flow, there's long-term appreciation growth. You have this equity, you own assets.
And lever it all day long. Yeah.
A leverage real cash flow, leverage real estate, right? And the middle class, the tax on the middle class really is inflation. Those that don't own assets will fall behind financially. That's the reality. So, but help me bridge the gap, because here you and I are saying own assets, own assets, own assets, right? We believe in that. We have bought cash flow and real estate assets for the last 20 years, and we're in a good position because of it. And because of owning those assets, our wealth continues to grow. But those that don't hold assets are in a worse position, and they're not keeping up with inflation. Their wages aren't keeping up with inflation. The cost of living, is higher than inflation. And we're telling those same people, hey, buy some assets. Yet, speak to those the young men and women that are going, hey, I hear you. I believe you. I want to own some real estate. I want to own assets, but it's unaffordable, and I can't even afford to buy my own single family home to live in. What do I do? Like, I hear you. I believe you. I want to own assets because I believe that'll put me in a better position, but I can't afford it. Home prices are too high. Like what do I do? Help me bridge the gap for those folks.
In my life, it's always come down to smart leverage, right? And leverage just isn't in the form of money. It's in the form of leveraging other people, maybe leveraging technology. And I know technology doesn't really play into this. I think my answer there is like, it depends on where you are at in your life. If you are a young person in your early 20s, get your ass up right now. Go get approved for what is it, a 3 or 5% down FHA loan.
Three
Go
and a half.
buy a, okay. Yeah. Go buy go buy a 3 bedroom house and rent out the damn rooms. That's what I did. I didn't even, it was called house hacking. I didn't even know it. This is like, cause I'm a little older than Brandon Turner. Rent out the rooms, go get a bank loan. That's one form of leverage. Go get your buddies to rent out the room. That's another form of leverage, and have them pay your mortgage for you through rent. They can't afford the house, right? They can't because it's expensive. So they need a place to live and they're going to pay you rent. And you're going to have great. You guys are going to have parties. You're going to drink beer and you're going to collect the rent every month. That's what I did.
So you're speaking to someone that has a good job, good credit, and they're bank qualified. What about those that don't? They're going, I'm working two part-time jobs. I'm making a minimum wage or above. The bank won't give me a loan, which I am. That is like me, you know, 20 years.
And
But
I had a VA loan too. So it was nice. I got a 0% loan from being in the military. That helped.
yeah, I didn't utilize that initially, right? But there was some other financing options. And again, you know my story. I got really creative and found other ways to finance real estate, right? So like speak to those people. They hear you. They say, "Yeah, Travis, I agree. Go to the bank and get a loan, but I don't have the down payment. I don't qualify for an FHA loan. I have two part-time jobs making minimum wage and my credit sucks. Like what do I do?"
Well, yeah, and also to add to that, and I'll answer your question here in a second. It was 2000, the year 2000, and I got a 0% loan because I was ex-military. I did have a good W-2 job at the time, a W-2 paying job at the time, and the house was $132,000. Right now, people are like, "How the hell am I going to do that?" Like you said, my wages haven't kept up. Like working 2 jobs, I can't. In this house, the median house cost in my hometown is $400,000 or $360,000. I think my answer to you is stop connecting your economic situation to the value that you can possibly create. A lot of people just look at the job they have, their after tax income, their bank account, their savings account, and then they try and decide, how do I make something out of that? And the answer is nothing, probably. You're barely keeping up. You're barely just paying your bills. And that sucks. And I'm sorry. And that hurts. I've been there, by the way. I think my answer to you is learn, get educated, because there are hundreds and hundreds and hundreds or billions of dollars of real estate out there that's undervalued, right? Whatever, for whatever reason, there's an opportunity there. If it's a multifamily property, the rents are under market, the expenses are loaded up as commercial real estate, the value is based on the profit. Go learn about commercial real estate. Go learn about how to take an asset and create value out of it, right? And that takes education. And by the way, education, you don't need an MBA anymore. Sorry, Harvard. For the price of $100, you can get an MBA. I think you can get NBA or at least commercial real estate knowledge at the MBA level, right? So you could go learn. You can go buy our book, the 0 to 100 book. You can buy Multifamily Millions by David Lindahl. Brandon Turner has some great books on multifamily. You can go go read Rich Dad Poor Dad, by the way, get your mindset right. So get educated and understand how you can do this. Get in a community where people are doing the same thing. And then when you break the connection between you having to go buy an asset and I just need to go understand how to find an asset where I can create a lot of value, then I can go raise capital. There's people that do have money that's sitting on the sidelines that's not earning anything. Maybe it's in the stock market, they want to diversify. Maybe it's in their bank account. They want to invest in real estate, but they've got a full-time job that makes them good money. Take their capital, pair it with that asset, operate that asset, and you're going to create value. That's the first thing that goes to mind. Raise capital, or like you did, look for those inefficiencies in the market, no money down, seller financing opportunities. They are out there. I mean, I don't know if it's as prevalent as like when you were coming up.
When I started buying, I had no money. I was working a barely above minimum wage job. I had great credit because I hadn't really, used my credit. So I had a perfect credit score. But I didn't have the income. I didn't have assets at the time. I didn't have cash or any kind of high paying job. But it makes me think, that resourcefulness is so much more important than resources. Like if you're resourceful, then you'll find the resources. You'll find ways to buy real estate. When I think it's getting scrappy, and also like make sure you're telling yourself the right thing. Like if you're telling yourself, I can't afford to buy a home, I can't afford to buy an investment property, is very different than saying, how can I? When you say, how can I? When your mantra is like, I'm poor, I'm broke, I can't, it's impossible, you start believing those things that you tell yourself. When you ask yourself the questions of like, how can I buy an investment property? How can I cash flow? How can I build wealth? When you're asking yourself those questions, now you're creating a scenario where you can help your own self solve that problem. How can I buy a house? For me, it was no money down seller financing. The problem was I had no money, but the language I was speaking wasn't like, oh, I can't buy a house. Oh, I can't afford it. It was like, how do I buy as much investment property as possible while not having a bunch of money? Like, how can I get creative enough to take down cash flow in real estate, even though I don't have a high paying job, even though I don't have a bunch of money in savings? How can I? And because I asked that question, I was able to solve for that problem and buy a bunch of no money down cash flow in real estate. And I think it starts kind of what to the point of like, hey, not needing an MBA from Harvard, like the information's out there. We live in a time where you can get the information, you can connect with people in your local community or across the world for that matter, right? And get the information and surround yourself with people that have already done what it is that you want to do, and do that, and then you become responsible and for your financial future. You take responsibility, you take the reins, and ultimately you create the financial freedom in your life that you desire.
Yeah, I mean, I love that you said that. Like, it's always a good, it's a good reminder for me too, from a mindset perspective. Like, I think the questions that you ask yourself, like you said, is really powerful. Like, is it Dan Martell's book, 10X is greater than 2X? Something that really hit me there. And then you were actually reminding me, I'm literally going to get off this podcast and because I have I'm going to start asking myself bigger questions, because it's like because you focus, you get out of the minutia and out of the scarcity mindset. You really focus on answering those questions. And when you do that, that's where you come up with solutions. And so for those of you that are listening, I mean, if you want an excuse just to stay where you're at and be pissed off about the devaluing dollar and the rising cost of the world and the fact that you'll never be able to buy an investment property, just keep saying I can't. And then it'll validate your internal narrative. But for those of you that want to break out, and Gabe and I didn't come from we're not trust fund babies, and um we weren't riding around in daddy's boat on the wakeboard, like we were poor kids. And when we were buying real estate early on, like, yeah, it was cheaper, but it was still a hell of a lot more expensive as it was a decade earlier than that, or two decades earlier when our parents were buying. So I mean, there's always this sort of sliding scale. Yes, it is a lot more expensive just when you factor in inflation than it was before. But there is a way, right? You can learn about cash on cash. You can do owner contracts, seller financing. You can do creative financing, maybe with a hard money lender. You can learn about commercial assets and how to force appreciate it. You can partner with people with capital. It really comes down to the questions you ask yourself. And I do believe in that. I guess to sort of put a bow on this thing, though, for people that are listening that disagree with because we sort of like started the show with like, yeah, I mean, it's less than 1% institutional money. Haha, it's really not going to move the needle. Let's move on. And I still believe in that.
Yes, I was just thinking, I'm like, we should completely
We just like dismissed it.
what was the episode on?
Yeah, well, I think, yeah, exactly. So maybe this is like 2 episodes. It's a mindset episode. I do want to get back to this institutional money thing though, because there is a fear, whether it's fabricated or whether it's real, and there's merit behind it. There is a fear that everybody's going to be living in a Blackstone house, right? Because affordability is out the window, and now I'm just a renter, and now you've got an oligopoly or a monopoly, and these people set markets in these towns, and they just crank up rent, and they maximize shareholder returns, and it's just sort of like the soulless corporation. Like there's a real fear of that. I mean, I think I was looking at a statistic somewhere, and I don't quote me on this, but the amount of things that BlackRock or Blackstone, which one is it? It's one of the black and the rocks, the stones of the rocks, and maybe both of them. But they were like, you think, like, they were talking about your economy when you get up in the house you live in, maybe, or the apartment that you're renting. the car you're driving, the food you're eating, like they sort of what you're consuming on social media. And they went into like how much of those things are owned by these large institutional players, and it freaks people out, especially when it comes to living. And so there is a real fear that, yeah, maybe it's less than 1% now, but eventually everybody's going to be just renting because they can't afford it, the next generation, and they're all going to be renting from BlackRock.
But the reality too is most rental properties are owned by local mom and pop owners that own 1 to 4 units, right? And so it's that's the majority of rental property throughout our
Okay, but
country.
that's the question. Oh, so when these mom and pops retire, do they go sell it to Blackstone or BlackRock? And then now,
Or you put yourself in a position and build relationships with these sellers so you can buy the property and set yourself up a financial future for yourselves and your family.
yeah, go start making some calls. Find a mom and pop that's getting ready to retire that owns these things outright, which is common, and they have maybe a portfolio of 5 to 10 homes, and they want to carry a contract on it because they want the annuity stream. And then you go get, you learn how this works. You go get a bunch of buddies together that have some capital, and you go do it. I do agree with that. I'm just trying to go back to like the actual fear of people. Let's say you're a real estate investor and you already own your own house. So you're not like really worried about Blackstone owning your house, right? How does this affect how does it affect us? We're small, on the grand scheme of things, we're smaller investors, meaning we have, several hundred units. But at the end of the day, that's not like, Warren Buffett or BlackRock or, these types of organizations. How does this affect us? How does institutional money going in and buying up all of these single family homes, how would that affect someone that owns maybe, a smaller to medium sized multifamily portfolio or mobile home parks, like residential properties, not industrial? How does that affect them?
Well, I think it's possible that one day they're going to be in a position where they get an offer from somebody that, whether it's an institution or individuals, that you'll have to really think, like, is it time to sell? Is the offer too good to pass up? Right. I do think that, with certain types of properties and, different organizations, different entities want to buy different types of properties at different times. And so if you're a holder of mobile home parks, you're a holder of multifamily or a certain asset class that some of these, larger groups want to buy, yeah, you may find yourself in a position where you have to decide, do I keep these properties and let them increase in value over time and reap the benefits of owning it myself and the cash flow, or do I sell? And I don't think there's a right answer for each individual investor. Everybody has their own investment philosophy, and I wouldn't hold it against anyone. If you are savvy enough to buy and hold enough cash flow real estate to where someday you get an offer on that real estate, it's like somebody building a company and selling to private equity, right? I mean, it's you've spent, these years building a company, and then you get an offer and you have to make a decision of whether or not you want to keep the company or have a big payday. And I think it's the same in real estate. I don't think there's a right or wrong. I don't think it's a matter of, selfish or not selfish. Like, you're going to make a decision based on, where you're at that time in your life and what makes the most financial sense and what makes the most sense for your life individually as well.
Yeah, I'm thinking about this two ways. Number one, if you like, I sold my company to private equity. It was great. It was a it was a great outcome for me, right? So private equity to me isn't a 4-letter word, but I also know if you want
There's
to,
a lot more letters in that. There are a lot more letters in the words private equity.
yeah, right, yeah, right, true. They're not the bastard in my mind. And this is a great company owned by good people. They took care of my employees. Like private, not all private equities are the soulless, heartless pigs that people think they are, though, although many are. So going back to the sheer economics of it, if you invest in an asset class that isn't consolidated, like when I say consolidated, that means a lot of private equity and institutional money, REITs or private equity has not come in yet, that could be a really big opportunity for you. Meaning mobile home parks is a great example, obviously, because that's what I know. 80% of those parks, 70 to 80% of those parks are still owned by mom and pops, right? People that are in their 60s, 70s, maybe 80s and looking to retire. If you can own those assets before, and private equity is really just starting to come into the space. We have a friend that has like 2,000 mobile home pads, and he actually got approached by private equity to buy his entire portfolio, or like everything but like 2 parks. And he's getting a price premium, right? These private equity people have a lot of cash they have to deploy to deliver returns to their investors and their shareholders. So like in that example, like I talk to Mitch about this all the time. I'm like, well, there's a really good opportunity to go buy as many of these mobile home parks as I can because, maybe where like a typical smaller investor is, going to pay you a 7 cap on your net operating income. Private equity is like, it doesn't matter. I'm going to come in and buy 4 and 5 caps and just crank rent. It's a sad story, but I mean, like just sheer economics. Like you could get a premium on the properties that you own if you're buying. And self-storage was this way. Private equity came into self-storage and did a lot of consolidation. But before that, a lot of people did really well that owned the properties that sold at premiums to private equity. So I do think there's a strategy behind that. To your point, like you're going to get a call someday, but if you own these assets by maybe a REIT or private equity, but you got to own the asset first to get the call. And so if somebody did go out and buy a bunch of single family houses and BlackRock was truly coming in and was going to take it from 1% to own 20% of the single family houses, as a real estate investor, you could benefit. And it goes back to what you said earlier. Owning real estate is better than not owning real estate. You could sell, you could not sell, you could sell at a premium, you could not sell and get cash flow. But like owning the asset is what puts you in the game. So get out there and own the damn asset. And then back to the economics, like if truly private equity could not go and deploy all this capital in single family houses because they were going to grow to 20%. Now they're not. Well, then where does that capital going to go? Is it going to, they still have to deploy capital. They probably still have mandates to deploy it into real estate assets. Well, that means it's going to go into commercial other assets. Well, what are other assets? It could be parking lots. It could be mobile home parks, which I think absolutely that's going to be the case. It could start going more into multifamily, although there's been a decent amount of private equity into multifamily. It could go into the assets that you own. So always kind of, if you can find out where the money's coming, get there first, right? They say, skate to the puck before it comes there. And I don't play hockey, but I've heard that saying. So own assets, get out there, maybe figure out where those dollars are going to go.